In this lecture, I'd like to talk in some detail about demand elasticity. Now, Mattel introduced the Hot Wheels car in 1968 at a price of $1, and they kept the price at or below $1 throughout 40 years of production, even as the production costs rose. Finally, in 2008, they tested a price increase of 20%, and lo and behold, they found that their profits increased as well. Why was that? That increasing the price actually increased profits. The reason, if we think about profit as being equal to the price minus the cost times the quantity sold, is that businesses tend to focus on the cost dimension and the quantity dimension, but actually often neglect the price dimension. In many instances, companies can actually increase their profit and generate higher profits simply by raising their price and selling fewer units. The purpose of this lecture is to talk about why this is the case from an economic perspective and to better understand consumer demand and translate that into better pricing decisions. Some of the main points of this lecture include the following. Price elasticity of demand can be thought of or represented. We're going to use a small letter E to represent elasticity of demand. And it, in conceptual terms, is equal to or defined as the percentage change in quantity demanded divided by the percentage change in price. To estimate the price elasticity of demand will require us to have two price points and the associated quantities or sales levels at each of those price points. We'll call the first price point P1 and the associated quantity Q1, and then the second price point P subscript 2 and the quantity sold at that price Q subscript 2. And the formula that we will use, a very standard economics formula, a type of midpoint formula, is calculated really using two terms. In the numerator, the first term is Q1 minus Q2 divided by Q1 plus Q2. That gives us an estimation of the percentage change in quantity. And then the second term is the difference in prices, P1 minus P2 divided by P1 plus P2, which when divided by the first term gives us an expression for the percentage change in quantity divided by the percentage change in price. And this is what we will use to estimate demand elasticity. And by demand elasticity, we're simply referring to a measure that gives us some economic sense of how sensitive consumer demand or quantity is for a given change in price. Now, if E, which is actually typically negative, it's usually the case that if we raise the price, so the price increases positive, the quantity demanded will go down, and so the quantity change is actually negative. So for economic normal goods, E, the elasticity of demand, will be a negative number. We will typically just use the absolute value of that, and so we'll refer to the elasticity using positive numbers, keeping in mind that that's an absolute value. Now, if elasticity is greater than 1 in absolute value, let's say 2, meaning that E itself was negative 2, but the absolute value is positive 2. So if E is greater than 1 in absolute value, we say that demand is elastic. What does that mean? It means that demand is price sensitive. Okay, that the change in quantity is really stretchy or elastic. When we change price a little bit, the quantity demanded responds a lot. Think about an elastic band stretching out. On the other hand, if E is less than 1 in absolute value, maybe 1/2, that tells us that demand is not very price sensitive. Demand does not respond much to changes in price, and we refer to that as economists as inelastic demand, doesn't stretch much or move a whole lot. Another key economic idea is that the percentage change in revenue can be approximated as the percentage change in price plus the percentage change in quantity. This means that if the percentage change in price, which might be positive, is greater than the percentage change in quantity, which might be negative, revenue is going to go up. Here we're going to use positive and negative values as they occur. But this tells us that either the percentage change in price or the percentage change in quantity may dominate the other, and that's going to dictate or determine whether the revenue goes up or whether the revenue goes down for a given change in price. Now, if demand is elastic, remember, elastic demand corresponds to a value of E greater than 1 in absolute value, which means that demand is very price sensitive. Quantity changes a lot when the price changes. Then, generalizing that, quantity changes more than the price in percentage terms. With inelastic demand, the opposite is true. Quantity tends to change less than price in percentage terms. Another key idea is that if marginal revenue is greater than marginal cost, this implies that the actual sales margin is greater than the optimal sales margin. The right-hand side of this equation, 1 over E, is equal to 1 over the absolute elasticity of demand. And as we'll see, that is the optimal markup level or the optimal margin. If E is, say, 2 in absolute value, the optimal margin then would be 1 over 2 or 50%. If E is 4, 1 over 4 is 0.25 or 25%. The optimal margin is given by 1 over E. The left-hand side of this equation is the actual profit margin or the actual margin. In the numerator, in the parentheses, is price minus the marginal cost. Economists refer to this as sometimes a contribution margin. It's the profit generated by each unit of sale, the price minus the cost of producing that unit. And if we express that as a percentage by dividing it by the price, then that gives us a percentage profit margin or markup. And if marginal revenue is greater than marginal cost, mathematically that can be shown to be exactly the same as the actual margin being greater than the optimal margin. Now, in that case, if that's the case, if the actual margin is too high, what does that mean? It means our price is too high, so we should reduce the price and sell more, which is exactly what the basic marginal analysis would tell us if we simply observed that marginal revenue was greater than marginal cost. That would tell us the same thing. We should sell more by reducing price. But this expression is going to become very, very useful. So the price minus marginal cost over price, or actual margin, compared to 1 over the absolute elasticity of demand, the optimal margin. This is an indispensable formula. Will become very, very useful. So if the actual markup is bigger than the desired markup, we should reduce the price or sell more. Now, how do we estimate marginal revenue? Well, price elasticity is a critical component of estimating or calculating marginal revenue. Now, price elasticity of demand, again, we defined as the percentage change in quantity divided by the percentage change in price. And if E is less than 1 in absolute value, remember that means that the demand is referred to as inelastic or not very price sensitive. If it's greater than 1, demand is very price responsive, meaning that if for a percentage price change, the quantity change will be even larger in percentage terms. So quantities respond very dramatically to a change in price. So let's consider what this means for the case of elastic demand. Elastic demand, remember, is associated with price sensitivity. So the percentage change in quantity is greater than the percentage change in price. Now, if we increase price, quantity demanded should go down. And in the case of elastic demand, the decrease in quantity will more than offset the increase in price, and the overall revenue will decline. So for elastic demand, if we raise prices, the revenue will go down. On the other hand, if we drop prices, we're going to sell more. So a reduction in price will lead to an increase in quantity demanded. Elastic demand tells us that the percentage change in quantity is greater than the percentage change in price. So the increase in quantity more than offsets the price reduction, and revenue is increased. This slide is useful for many people to just kind of talk through this point several times and kind of think through the economic logic. of what elasticity tells us about whether revenue will increase or decrease in response to a change in price. I'd encourage you to pause the slide and think through that logic before proceeding. All right, now, in many examples, the price formula is not necessarily used, but the price elasticity formula is calculated as a percentage change in quantity divided by a percentage change in price. The left-hand side here, Q1 minus Q2 divided by Q1 plus Q2, would be calculated if we had two sets of prices, a beginning price and its associated sales level, and an ending price and its associated sales level. We can calculate Q1 minus Q2 over Q1 plus Q2. That gives us an estimate of the percentage change in price, or excuse me, percentage change in quantity. And then we divide that by the second term, which estimates the percentage change in price. So let's consider an example of estimating demand elasticities. And really, the only way a firm can estimate its demand elasticity and understand the shape and the slope of its own demand curve is by running experiments, by changing the price and paying very careful attention to what happens to consumer demand or quantity demanded. So let's suppose that Doritos sells at a price of $2.99 per bag, 5 million bags of tortilla chips per week. So I'm going to let P1 be $2.99 and Q1 equal 5 million. When they raised the price to $3.19, the quantity demanded dropped, as we would expect, and it dropped to 4 million bags per week. So I'm going to let P2 be $3.19 and Q2, the associated sales level, 4 million bags. I'd like you to pause this lecture for just a moment and use the formula from the previous slide to try to calculate or estimate the elasticity of demand, which again tells us how sensitive consumer demand for, in this case, Doritos, was to a change in price. Now, you're going to get two quantities, first associated with Q's and then in the numerator, and then a percentage change in price in the denominator. And I came up with, in the numerator, 1 over 9 or 0.111. And then in the denominator, I came up with 0.20 over 6.18 negative, which works out to be negative 0.032. And if we then take 0.111 divided by the negative 0.032, you should come up with an estimate of negative 3.47 for the elasticity of demand for Doritos tortilla chips. And this is very much in line with many empirical marketing studies that would suggest that the demand for things like tortilla chips is somewhere anywhere between 2 and 4 in absolute value. So this is right in line with what we would expect. Fairly price sensitive. Now, let's consider a second example using some pricing data on 2 and 3 liter Coke sales. There was a time when Coca-Cola actually, as a promotion, produced 3 liter bottles of Coke. And Walmart very much marketed this and actually implemented a 3 liter or marketed a 3 liter bottle of Coke that was at the same price or sold at the same price as the 2 liter bottle, $1.79. And so a particular store was trying to estimate the demand, consumer demand for large quantity bottles of Coke, 2 and 3 liter bottles of Coke. And so we see here in the first column the initial pricing was at a price of $179. There were 210 million 3 liter bottles being sold and 120 million 2 liter bottles being sold. So we could also calculate then the total liters sold, that's the third row, and that works out to be 870 million liters. Now, there was a promotion that was implemented at Walmart, and many other retailers followed suit, where they cut the price to $1.50. And so it's interesting then to ask how that price reduction changed or affected consumer behavior. And what's interesting here is because we've got a couple of moving parts. We have both a 3 and a 2 liter bottle of Coke. We also have changes in price. And so they cut the price to $1.50 on both the 2 liter and 3 liter bottles. And here's what's really interesting, is that when the price of the 3 liter bottle of Coke went down to $1.50, we see that the demand for the 3-liter bottle skyrocketed, and the demand for the 2-liter bottle actually declined. So if we look at the quantities from column 1 to column 2, we see that the increase in demand for the 3-liter bottle actually was pretty dramatic. And as a percentage change, it's calculated there as 66.67%. The price dropped by 17.63%, and the implied elasticity estimate, which is equal to percentage change in quantity divided by percentage change in price, is equal to negative 3.78. What's also interesting, if we look at row 2, is that the cross-price elasticity, if we look at the percentage change in the quantity for the 2-liter bottle and the percentage change in price for the 3-liter bottle, both of those went down. So when Coke cut the price of the 3-liter bottle, it actually reduced the quantity demanded for the 2-liter bottle. Now this sort of makes sense because the 2 and 3-liter bottles are substitutes. And consumers who flocked to the 3-liter bottle, many of them probably were simply abandoning their purchase of the 2-liter bottle. And so we can calculate, in addition to a price elasticity, which was the negative 3.78, economists also like to compute cross-price elasticities. How does the change in price of the 3-liter Coke affect demand for the 2-liter Coke? Or how does the change in price of Samuel Adams beer affect the demand for pretzels? Okay, related products. Sometimes those products are complementary. Other times the two products may be substitutes, as in the case of Coke here. We see the elasticity, the cross-price elasticity, is a positive 4.86. So when the consumers flock to or increase demand for one, in this case the 3-liter bottle, it comes at the expense of the other, the 2-liter bottle. Now the intuition behind much of this analysis is the following. Revenue and price elasticity are very closely related. The percentage change in revenue, we've said, can be estimated as the percentage change in price plus the percentage change in quantity. Elasticity tells us the size of the percentage change in price relative to the percentage change in quantity. So in particular, if demand is elastic, then what that tells us is that quantity changes more than price. So if price goes up, quantity goes down by more than enough to offset the price increase, and revenue therefore goes down. If price goes down, quantity will go up, and if demand is elastic, the quantity will go up a lot. In fact, so much that it more than offsets the reduction in price and revenue increases. If demand is inelastic, the opposite holds true. If price goes up, quantity demanded will go down, but not by very much. Remember, inelastic demand means that demand is not very price sensitive. So in that case, revenue will actually increase. The price increase more than offsets the quantity reduction. On the other hand, if demand is inelastic, then if price goes down, yes, quantity demanded will increase, but not by very much. And in fact, the reduction in price more than trumps or offsets the increase in quantity, and overall revenue goes down. Historically, here's an interesting application of this. In 1980, Washington, D.C. then Mayor Marion Barry actually raised the sales tax on gasoline within the District of Columbia by 6%. The idea there being that the increased sales tax would increase or generate additional tax revenues. What actually happened was that tax revenue declined by nearly 40%. One of the reasons for this was because demand for gasoline within the borders of the Washington, D.C. area was very price sensitive. So many people buying gas in Washington, D.C. were commuting from outside the area, and so they had that enabled them to be very price sensitive when they observed, say, a price differential of 6% between the gas station where they left home in Bethesda, Maryland, and the gas station near where they parked for work in Washington, D.C. So in that case, price elasticity was very, very high. What that meant was that when price went up, quantity went down, quantity demanded went down by a lot. In fact, so much that the reduction in quantity more than offset the increase in price, and overall revenue went down. A very, very important formula here that we'll take as given that economists will refer back to when dealing with or analyzing marginal pricing and marginal revenue is the following. Marginal revenue is equal to price times the quantity, in parentheses there, 1 minus 1 over the elasticity of demand. Now, this is important for a couple of reasons, and most of these are just economic and intuitive reasons. And the first is, what does this tell us? This tells us that marginal revenue, which is an extremely important element of the pricing decision, is a function of two things: the price level and consumers' sensitivity to changes in price, which is captured by E. To the extent that we want to zero in on marginal revenue and the determinants of marginal revenue, then we can see that that is intricately linked to the elasticity of demand. And so we really cannot understand marginal revenue unless we know for a particular firm or particular product the properties of the elasticity of demand. Now, if E is greater than 1, we say that marginal revenue is positive. So this is consistent with this formula, elastic demand. And if elasticity is less than 1, if we're inelastic, what this tells us is that marginal revenue will be negative. Another important use or application of that formula is that if marginal revenue is greater than marginal cost, which of course we know means that we should be selling more or reducing price, that is equivalent to the following formula. We can work this out. Price, we'll just substitute from the previous slide the expression for MR, for marginal revenue, which is equal to price times that term in parentheses, 1 minus 1 over E. So marginal revenue greater than marginal cost is mathematically equal to the expression we see here on the slide. A little bit of algebra and a little bit of rearranging of this allows us to move some of the terms around and show that that is also equivalent. All three of these bullet point formulas or expressions are equivalent mathematically. And the last expression, price minus marginal cost, all divided by price, that, remember, is the actual margin or markup on the product, is greater than 1 over the elasticity of demand, the optimal margin. This is a very simple derivation, but it shows us where this formula comes from. The formula, again, is important because it gives some additional structure or depth to the formula. MR is greater than MC. It shows us a little bit of what's going on underneath the hood, so to speak, that leads to that condition. And marginal revenue exceeds marginal cost only if the actual margin exceeds the optimal margin. So let's take an example or application of this. Suppose that the elasticity of demand for a particular product is 2 or negative 2. So we have elastic demand. The price on this product is $10 and the marginal cost is $8. Should you raise the price? Well, it would seem like we would need a lot more information in order to answer the question, should we raise the price? But in fact, we don't. The optimal margin we know is 1 over 2, 1 over the elasticity of demand, which is 1/2 or 50%. The actual margin you can verify is 10 minus 8, which is $2 divided by 10, 20%. The actual margin of 20% is way too low in this case. What does that mean? Well, it means in order to get our margin up, we need to increase the price and sell fewer units. So in this case, should we raise the prices? Yes, we should, because the optimal margin is well above our current actual margin, and we need to raise our price in order to get to that optimal or profit maximizing margin. Now you might ask, how do we know that that's going to maximize profits? And in a different lecture, we will certainly talk about that, but the key idea here is that the elasticity of demand, E, has embedded within it a tremendous amount of information about consumer demand. And simply knowing these three pieces on this slide is sufficient to tell us that the price is too low. So the elasticity of demand is an incredibly powerful and useful measure and tool and gives us some insights into consumer demand that we really can't obtain any other way. Many salespeople will focus on whether marginal revenue is positive or negative, and always focus on producing more units as long as it generates additional sales. That's really the wrong approach. The right approach in pricing or financial or economic decision making and from a marketing strategy should always be, does marginal revenue exceed marginal cost? If it does, then we should expand output, but only if marginal revenue exceeds marginal cost is it profitable to do so. Thanks for listening.